As the economy emerges from the global pandemic, there's concern among investors that the monetary and fiscal stimulus deployed in response to the shutting down of large swaths of the economy due to the pandemic could now fuel a rise in inflation. So, Steve, perhaps you could start us off with a simple explanation of what it is that inflation is and how does it come to take hold?
So inflation refers to the change in price of a good or service from one year to the other. Every good, every service has its own inflation rate. You can get inflation if there's a sharp increase in demand and that outpaces the increase in supply. You can get inflation if demand stays the same but the supply contracts, or you can get inflation based on expectations. If people think prices are going up in the future, they might buy now. If people think the prices are going down, they may delay their purchases.
Great. So one thing that has been discussed recently is the fact that inflation may be transitory. So we may get some inflation, but that may not last. Is that where you think this thing could go, or is there a reason why we might be more concerned?
So the Federal Reserve Board and some leading economists have been broadcasting a message saying that inflation is transitory. Don't worry, inflation will tick up briefly and it'll go right back down again. Many are still worried about deflation. However, we must remember that psychology plays a big role in what happens to inflation in the future. It's a big influence. Psychology can be self-reinforcing. If people believe inflation is going to be worse in the future, they will behave in a way that creates it to be worse, and vice versa. Now, the Fed is particularly focused on bringing down the unemployment rate. And the way they're doing that is they're holding interest rates at 0%. And every month they print $120 billion worth of reserves. And they don't want to stop that until the unemployment rate gets lower. So they're hoping to control inflation, not through actions by raising rates or ceasing the operation of money printing. They're hoping just by their words, by telling people inflation is transitory, that'll hold it down. Now, if we keep getting surprises to the contrary, investors are going to start to doubt the Fed, and they can build in an inflationary expectation that's beyond what the Fed wants, and that could in fact cause inflation. It reminds me of the mirror image of what happened in the 1970s and early 1980s. There, inflation kept going up relentlessly, and it seemed like no matter what the Fed did, it kept climbing, all the way until when people almost gave up hope that inflation would ever come down again. Finally, they acted so strongly that it came down. This is the mirror image where now there are people who think, other than a temporary bounce, we're into deflation forever. And yet, I think that with all that the Fed has done, we might finally get our inflation.
All right. So let's harken back, not quite so far, but to 2008. And we remember that, again, the Fed created a lot of very easy monetary policy, which was appropriate because we had the great financial crisis and the housing crisis, et cetera. But I do remember back then there was a great deal of talk about how all of this action by the Fed was going to be inflationary and even hyperinflationary, yet that never materialized. So is the situation today different than that?
So I would say it is different. Like then, today, the monetary stimulus has caused a great increase in the money supply. But this only creates the potential for inflation. For that money supply to turn into real inflation, we need some kind of a catalyst. So the analogy would be, let's say you're trying to build a fire in a fireplace. You're adding up the wood, you're putting in the kindling, and you're creating the potential for a big fire. But until a match comes along, there is no fire, or in this case, there is no inflation. So if we look at the chart, you can see how money supply is accelerated quite dramatically, and yet we've had no inflation. The reason is that the money that was created up until recently, it just really didn't change hands in a rapid way. It just sat there in bank reserves, it sat in balance sheets, didn't really change hands in the real economy. And that speed at which money changes hands is called money velocity. So I'd like to show the second chart. You can see that the big increase in money supply was completely neutralized by a plunge in money velocity. Money just didn't change hands. So for the inflation to come, something has to come along to reverse the money supply from money velocity from plunging to rebounding again back to normal. And that missing link that didn't occur in the past but is occurring now is fiscal stimulus. The government actually spending money. The Fed can only lend, the government can spend, and they're putting money directly in the hands of people, in the economy. This could be the catalyst that finally turns that money supply into inflation.
That's great, Steve. So obviously no one knows whether inflation ultimately will become a long-term problem or not, but it does seem as though investors should at least be prepared for the possibility that inflation could prove to be problematic or at least potentially lasting longer than the Fed insists it will. And so with that being said, how can we as investors prepare ourselves for at least for the potential of a period of rising inflation?
Well, Fritz, we do believe this is a regime shift where the rules of the game change, and the investment strategies that worked previously are unlikely to work now that things are changing. So here's how I would describe some of the important changes in investment strategy that would accommodate rising inflation, period. One is with equities. Before the rising inflation, the equities that did best were companies that could grow independently of underlying economic growth, that they could grow on their own, and those future earnings were discounted with very low interest rates. Now, in a more inflationary environment, the companies that should do best are the ones whose fortunes are most tied to the real economy. So this would suggest a rotation from growth equities into value equities. Mm-hmm. Secondly, we think about US equities versus international equities. Mm-hmm. The nature of the S&P 500 index, the index of US stocks, is that it has lots of growth equities within it. The nature of the international equity indices are that they have a bigger concentration of value equities. So we see a rotation from US to non-US. Mm-hmm. And then finally, bonds or fixed income do best in a very low inflation, low interest rate environment. And we've had that for a long time. Now with this shift, we value a rotation out of fixed income, out of bonds, into real assets like gold and commodities that benefit from rising inflationary expectations and perhaps stronger economic growth.
Excellent. Thank you. That's a great explanation. And I hope that you have found this brief discussion about inflation to be helpful and that we've provided some insight into why it could make sense to at least begin to prepare for a potential period of heightened inflation. So thank you very much for listening, and we'll see you next time.